Hey, Mr. Jeremiah, how you doing?
I'm doing good, Edwin. How about yourself?
Really good. So first of all, my name is Edwin Rivera. I'm with the Millennial Realtor, and today we have as a guest Jeremiah Flores. Do you want to introduce yourself, Jeremiah?
Absolutely. Thank you. Hi, folks. My name is Jeremiah Flores. I'm one of the Millennial Team's preferred lender. Tons of experience, over 2 decades of doing mortgages. And I think outside the box. So when it comes to getting clients structured, the best possible finance options, the best possible either down payment assistance programs, and more importantly, also to shop their rate, because I'm a broker, I get to do that for you. So I get to actually advocate for the best terms in your financing. So hablo español, bilingual in Spanish also. So we're here to serve. Thank you.
That's good to hear. Well, I can tell by the white hair that you have a long, so many years in lending. I heard it's kind of stressful, by the way.
Absolutely, yeah. This market has had its ups and downs, and it's definitely added some grays to my facial and my hair.
Yes, yes. Okay, so today's topic, and a lot of people, like we do real estate and lending, they go hand in hand because I would say probably 99% of the transactions they usually finance, so they don't buy cash.
Correct.
Okay, so one of the big questions right now that a lot of people are asking is, hey, Edwin, when will rates drop? Like we've been waiting. We got spoiled, by the way. We got spoiled back in 2020, 2021, and probably beginning of 2022 with a 3% rate.
Yeah.
That, in your opinion, is that at that moment that was a normal rate, or which
No.
one do you think is a more of a normal rate? First of all.
Yeah, absolutely. So obviously what happened within those years, and we're talking about during COVID and just post-COVID, what the feds were trying to do, which the federal government is what regulates and controls the market when it comes to interest rates on banks to lend other banks money in order to be able to finance for either FHA, VA, conventional financing, and some of these private money lenders that do a lot of like non-QM, which is going to be for borrowers that are self-employed, don't want to submit their tax returns to qualify. We can use we can use bank statements, a CPA letter, a P&L, a 1099, different variations. Basically, the feds kind of control the market when it comes to the Fed rate. So with that market that happened through COVID, that was a very abnormal market. And what was trying to be done was they were trying to anticipate what was going to happen with the real estate prices. They actually thought the opposite was going to happen, but it actually created a big buying frenzy. So the feds came in thinking that people were losing jobs, they were losing employment, they were losing sources of income. So what they thought was, let's lower the rate in order to boost real estate, economy. And everybody took advantage of that. The people that either bought within those years or homeowners that already owned homes, they were able to actually refinance and get themselves into the 2s, 3s, and 4% rates, depending on their actual like package of file to qualify. So both Edwin and I and the whole team of Millennial Realtors, we helped hundreds of families buy within the super low interest rate market. And for those that bought years prior, we were able to also help them capitalize the best rate for their refinances. So that being said, that market was very unordinary, very unique. And that typically is not the normal real estate market. So the people that took advantage and bought within those years or refinanced within those years, they're sitting really pretty. What is also holding back inventory is some of those buyers or some of those homeowners that bought and refinanced to get those super low rates. They're being spoiled because they don't want to give up that rate to move into a new house that maybe they need to transition into because they need more space or maybe downsize and less space. But they're very spoiled with having a super low rate for the payment, and they don't want to give that up in order to make that next move. So that's kind of what's slowing down a little bit of real estate economy also, as far as seller market inventory. But as rates are steadily getting better into our traditional market rate, which is what we're seeing today, but everybody still remembers 21 and 2020. thinking that we'll maybe see 3s and 4 interest rates again in the near future. I honestly don't believe we'll probably see the 2s and 3s again in the near future, but I believe that we will probably see our high 4s and into the 5 rates probably within the next 12 to maybe 18 to 24 months. So again, I think Edwin and I and the whole team, we always talk about educating our buyers. What's the most important thing to do is to lock down the inventory, which means real estate. And then later, when the opportunity comes to refinance, let's help you refinance and get to a lower payment, of course. But the point is, buy something so you can be able to refinance, because if you don't buy real estate, you can never refinance.
And that's true.
So,
So technically, so the rates. So technically, what we saw back in 2020 to 2022
mhm,
is something you can say not normal.
not
Okay.
normal. Correct.
So if people are hoping, hey, rates will drop, don't hope for the 3% anymore. That only happened because of the pandemic in order for the economy to continue moving forward instead of the economy to stop due to the COVID
Correct.
restrictions and a lot of sectors of the economy to be closed.
Correct.
Okay,
Yes.
so now from what I know, the rates is on the high, on the mid 6% all the way to 7%, depending what type of product you're using, as if it's BA, FHA, or conventional.
Hmm.
Now, we've been hearing, at least since last year, a lot of noise was happening. Last year, the rates will be dropping this year, at the beginning of the year. And I believe that, who control mainly the rates is the Federal Reserve, correct?
Correct. Yeah. That in
Now,
the bond market. Yeah. Correct.
okay. So last year, probably I think it was probably the last quarter, the chairman for the Federal Reserve mentioned, hey, we're gonna cut rates at least 4 times, 3 to 4 times in 2025.
Hmm.
We are about to finish the second quarter, but me as a real estate professional, I don't see that is happening. You know,
Correct. Yeah.
why do you think it's not happening? If according to what, as long as like inflation goes down, employment goes up, rates should be able to go down. But what is not happening according to your professional opinion?
My professional opinion is that what that message was said for last year in preparation for 2025 is that they were anticipating that the actual inflation rate would be at a certain percentage. And going in through this year, the beginning of the first quarter, and in through now the second quarter, inflation has been holding steady and it hasn't dropped enough for the Federal Reserve to feel confident in order to drop the interest rate, especially with all the cost of goods keeping steady and staying like basically as expensive as it is. With doing the opposite and dropping the rate, that may create a little bit of another frenzy, and I think that's what they're trying to avoid. They want to try to stabilize the market, keep it kind of plateau. And that's the one of the major reasons why they haven't actually like committed to sticking with that original plan of the 4 cuts throughout this year of 2025. Now, if we remember though, compared to August of last year, all the government financing type of rates were, meaning FHA and VA, they were between 7 to 7.25%, and then conventional hit the highest at the time for the last like decade of 8%. So compared to last year of August, almost a year later, we're now low sixes for FHA and government financing, and then either high sixes, low sevens for conventional. So in reality, it's been about 1% drop compared to last August. But again, with the news media and everybody pumping out 2025, we're going to cut rates 4 times. That's what everybody remembers. At the same time, we have to keep in mind that the cost of goods as is just as expensive. So I think that's what the Fed rate is trying to hold back on when it comes to like just kind of, to say in layman's terms, dropping the shorts, with cutting the rates as drastic as they originally had anticipated and planned.
So now, so you mentioned the goods are not going, meaning inflation is not going down.
Yeah.
So the whole situation of the tariffs,
Mhm.
United States is putting tariff on Mexico, Canada, China. Usually, those are the three major countries that we trade a lot. You think that kind of delay rates going down?
Yes, that's actually creating a big influence in why the feds are not cutting the rates as anticipated because of the fact that the tariffs are just new to the process of the economy right now. And from what all the reports are saying, it's too early to dictate what really tariffs is going to do. So they're kind of like, what they're basically doing is they're being very conservative. They're wanting to see more data to see what the tariffs will really truly influence before they make their next decision of Fed rate cut. And I think that's actually what the uh, major restriction, or better yet, the biggest conservative purpose of why they haven't cut rates as of yet. It's because they want to figure out what the long term of tariffs is going to do with the economy, and then from
Okay.
there they'll figure out what's the next step.
Okay. So they don't want to, technically, they don't want to cut the rates, without knowing what will be the effect of the whole tariff situation in the economy.
Correct.
Okay.
Correct.
Now, I remember back in March, beginning of April, we had a rates going down without the Federal Reserve to lower the rates.
Mhm.
Why that happened, and can that happen again?
That is a good question. I believe earlier this year there was a lot of news media about, obviously, like the war going on between Russia and the Middle East and etc. So that was putting a little bit of scare into like the stock market, which also is controlled by the bond market. So a lot of investors were getting scared with traditional stocks and acquisitions. So they were putting more money into the bond market because historically the bond market has always been the most safest return on investment. And when you have tons of banks, when I say investors, I mean more banks. When banks are dumping money into the bond market, that actually gives the ability to have the banks lend on a lower Fed rate cut interest rate. So with that being said, if there's scare to the economy or any type of global news, that may put influence into what the bond market will do, which in reference then falls back into the banks lending the money.
So
So if we have further like catastrophes or bad global news, that's going to potentially also influence rates again.
okay. So technically, what I'm understanding is that when the stock market, because at that moment I remember, that's when the tariffs were announced for different countries,
Hmm.
and that's when the stock market went down. So usually, if the stock market goes down, in some cases, rates can drop with the rate with the stock market, right?
Correct.
When the,
Correct.
so when the stock market goes up, the
Everything
rates
else goes
follow
up.
as
Yeah.
well.
Yeah, exactly. It's kind of like a pairing of a transition, whether it goes up or whether it goes down. It's gonna be kind of mirroring what the stock market is doing. So obviously, with global news, that's either negative impact in the financial sector, that's going to influence the rates to possibly drop. If things are going up, meaning that stock prices are going up and etc., that's going to influence rates to go up just as well. So, I mean, it's sad to say we don't want, any type of like War 3, but news like that is what scares the market. And then that's where the rates start to drop. And it's literally kind of like to say, it's like finding a needle in a haystack when it comes to trying to time the market perfectly. So I know that's probably one of your next questions. Like, what's the best way to time the market? And it's kind of that's basically my biggest philosophy of like advice. Kind of follow what the global trends are happening around the world, whether that's regarding, like you said, tariffs or Israel, Russia, and etc. That and Gaza. That's kind of like the newest news right now going on with the world news to say. So again, I cannot stress enough. If
You,
you could buy now, and we'll help you refinance later because
you know what? I always, one of the questions people ask us is like, "Hey, Edwin, when do you think prices will go down? When do you think rates will drop?" Trust me, I would love to have a magic ball. That way I can tell the future, but that's almost impossible.
correct.
And the way I tell people, you know what, buy a home when you feel ready. When you feel you
Yeah.
have the down payment, or you able. There's a lot of down payment programs that they can use.
Mhm.
when they feel stable economically and they can pay a mortgage. Okay. Now, if you ask me if you're paying rent, then yes, you can pay a mortgage. So it's not a perfect time. Something I will tell you this: if you buy today in 2025, I guarantee the people who purchase in 5 years, 2030, they're gonna say this comment: I wish I purchased a home in 2025. You know,
We hear that all the time.
yeah, like people now they say like, I wish I purchased a home back in 2020 when rates were lower and prices were lower. You know, things are just getting expensive. Something I noticed as the time go by, less people are able to afford to purchase a home. You know.
That's true. That's true. That's good that you brought that topic up, because that's one of the conversations is that we have with clients all the time. I should have bought 2 years ago. I should have bought 5 years ago, or in the future, I should have bought 5 years ago, 2025. Well, everything continues to gradually increase, and that's the typical historical climate when it comes to real estate. There's going to be peaks and valleys, but at the same time, it's gradually going up. So appreciation happens almost to say in every market. But more importantly, when you're trying to, I guess you could say, when you're trying to price yourself for 2025, and then you don't buy the same style home or size of home, and 2 years later the price of the home may be 20, 30, 40, maybe $50,000 more. So now you could have technically basically priced yourself out of a certain either neighborhood, city, or more importantly, school district. So those are probably the main three topics of people's conversations when it comes to like home purchasing. If they have young families or if they have growing families, they want to look at long-term investment, long-term stay. That way they're not buying and selling and buying and selling right away. Those are the three major questions that they ask us. We're looking at this neighborhood because of school districts, or we want to be in this county because it's better than the county that I'm coming from, or it's more affordable, I can get more house, or I'm relocating for work, whatever the case is. Those are one of the three best scenario questions that always get asked. Like, we're moving for these reasons.
Okay. And by the way, just to let you know, we live. So also for the audience right now that is looking through either Facebook, Instagram, or YouTube,
Mhm.
if they have any specific question regarding lending that you want to ask Jeremiah or myself regarding real estate,
Yeah.
just feel free to drop a comment. If we're still live, we're going to answer the question live and provide the best answer possible. Now, okay, so now we know why they're not dropping. Now,
Mhm.
the next topic will be, so you kind of mentioned at the beginning, when do you think they're going to drop? And if they drop,
Mhm.
how do you, what do you predict they're going to be landing?
Okay, that's a great question. So on the immediate side, at least within this year, I see rates dropping at least probably by 0.25% throughout the end of this year. And what I mean by that is it could happen next week, it could happen next month, it could happen in December or November. It's really hard to predict. But again, I feel that by the end of year, we'll at least have 0.25% to maybe, if we're lucky, 0.5% less in rate. And then by next year, 12 months, between 12 and 18 months, I'm hoping and expecting somewhere between 1 to maybe 1.5% in a drop in interest rate. The 1.5% may fall closer towards the 18 to 24 months from now, leading into 2027. But at the same time, again, we can't, like Edwin and I and the whole team, we can't stress enough. If you can afford to buy, buy. And then when it's affordable to refinance, we will happy to refinance. But again, for those that are trying to time the market, again, when rates drop, remember this as well. When rates do drop, prices go up. The reason why is because now you have more demand of the same inventory, meaning you have more buyers that are looking at the same property that are willing to bid 5, 10, maybe 15, $20,000 more because they're desperate to buy that house, or they're desperate to get into that neighborhood or that school district, and etc. So it's very, very impossible to time the market. But like Edwin said, just please, if you can afford to rent, you can absolutely afford to buy. It's just getting over that fear of commitment. I think that's the biggest fear most people
That
have.
is.
Yeah.
That is 100% true.
Mhm.
If you can able to pay rent, you can afford buying a house.
Yeah.
Now, something that you mentioned, so rates will drop eventually. Now,
Right.
which people is a good timing for them to refinance if they have what percentage and above? Like
Oh,
if you already
yeah.
purchased, so 2023 there were high rates, 2024 there were high rates, 2025 they're cooling off a little bit, not too much, but they're
Yeah.
cooling off. But the people who bought in 2023, 2024, if they have which rate, you tell them, hey, talk to us, talk to the lender so they can refinance.
Yeah, absolutely. I'm still meeting people that are coming in with their mortgage coupon that have like a 7.25, 7.5, even 7% for FHA. So for anybody, whether you're FHA, VA, government financing, if you're 1.5% to 1% higher than the current market, it's time to refinance for sure. So if you see yourself with maybe even a 0.5% in interest rate that you're maybe paying, example, on a conventional loan, you're paying 7.625, but the current rate today is at 6.99 for conventional, as example, that's more than enough to be able to start the process of a refinance, because even that 0.5% in interest rate, depending on your loan amount, you could be saving anywhere between $200 to maybe $500. Again, it really depends on the loan amount, of course, but that's a pretty drastic savings per month. And then, of course, there's no penalty to refinance. The only thing you're paying is just possibly anywhere between 25 to maybe $3,500 in closing costs. The other portion, if you want to have your mortgage impounded, which means to include your taxes and insurance, the other portion of that is going to be rolled into your loan, and you'll get a refund from your existing mortgage lender that we're paying off, and you'll get that refund back. So in essence, less than $5,000, and you could start saving a couple $100 a month today if
Okay.
you're in a higher 7% or high sixes for FHA government financing.
And those same people, if rates drop eventually in the future, can refinance, or they can only refinance once in their lifetime.
No, you can refinance as many times as needed, as long as it's a benefit. Nobody wants to spend more money than needed, but the earliest opportunity that anybody can refinance after their most recent refinance is after they've made their most recent new six mortgage payments.
Okay.
Six mortgage payments. So that means if the market drops every 7 months, you could continue to refinance until you get to the best payment possible for yourself.
Okay, perfect. Now, I have a question. So I know I've been hearing the news. Something that I was seeing is that the chairman for the Federal Reserve, what is his name? Powell,
Jerome Powell.
Jerome Powell. There you go. And the President Trump, they being beefing, regarding, I know the president is requesting, hey, drop the rates,
Yeah.
especially because we have some bonds that they need to be refinanced, but
Hmm.
he doesn't want to do it due to the whole economy situation.
Correct.
Who elects the chairman for the Federal Reserve? Can the president fire him, or when can that be reelected or replaced?
The Senate has to choose a new person, and Jerome Powell's term is coming up by next May of 2026.
Oh,
So if there's enough I'm sorry, um, disturbance in the sense that if there's not eye to eye that meet their own standards, then Jerome Powell could potentially be out, and a new person can be replaced for him. And if that's the case, then that's where I'm really thinking that by next year for sure we're gonna have rates drop. That's almost to say kind of a guarantee. If you want to hold my word to that, I would probably bet on my word
I'm
regarding by next year rates
gonna
will drop.
record you right now.
Yeah, absolutely.
Okay, so technically, you're saying we're gonna blame him because we have high rates right now.
I mean, to a certain degree, yes. I mean, he's how would you say it? He's one piece to the whole chessboard. So you can't blame everything on him, but at the same time, he does hold a huge influence on whether we do the Fed rate cuts now or later, and etc. He's just seeing things in a more conservative way. That's basically what's happening right now.
Oh, okay. Now, something that is happening since I believe Friday, Saturday. So there has. So we're from LA County. Um, most of our clients are from Southern California that we help, and a lot of things have been happening. There has been a lot of immigration riots. Here in the city of Whittier. Yesterday, I saw in few times immigration cars. Even myself, I saw when they were stopping someone in the location. So there's a lot of noise happening, and there's a lot of protests happening in different cities in Southern California as well. Do you think that is might impact the rates at some point? What do you think that will impact on the rate market, on the loan market as well?
If that continues, and let's just say worst case scenario, for whatever time being or however long of a time being that this does happen, if there's some form of like a martial law that gets enforced, that's going to create uncertainty in stability. And when there's instability in the market, or better yet, like bad news, global news like that, that's what creates and influences a little bit on the interest rates. So if this continues the way that it's been happening these past couple of days and weeks, then it can absolutely make an influence on the interest rates to drop as
Okay.
well.
As of right now, have you seen any change on the rates because of that
Mhm.
specifically, or everything is continuing as normal when it comes to the rates?
I think right now everything's kind of continuing as normal because that information of like the protests and the raids and etc. That's so brand new that it hasn't really like trickled down through the process to make an impact on the rates yet. But if things like that is what I mean about like bad news, like global bad news. I know it's not global, but I mean as far as like that's local news to us. But at the same time, that can be a potential scare, to our country, and that's what creates sometimes is instability.
Yes. Okay. Now, so the people who's still looking to buy a house
Hmm.
in today's market with today's rates,
Yeah.
today's pricing,
Hmm.
what would be the best thing to do for them to get a better rate? Like for example, what are the things that influence in today's market for someone to get a 6.25 rate versus a 6.9 rate, as an example? What are the things the consumer can do in order to get a better rate?
What we always educate our buyers to do through our consultations, they're free, by the way, free consultations, is we always advise, please do not open new credit. Don't, co-sign for someone on a vehicle. Try not to buy a new car if not necessary. Wait for the car, wait for those luxury items after you've purchased your home. But more importantly, as you're going through the process of the pre-approval, if there's anything that both either the millennial team or myself and my team can educate you regarding, like if we can get you to the next credit bracket, we will educate you and give you that information, that knowledge for free, to help you get into a better interest rate. And more importantly, just maintain your credit as what you're doing already, meaning like make your payments on time. Don't get in debt with credit cards. Please try to all the consumers and all the clients out there looking at this or watching this video, pretend that your credit card is your debit card. Don't spend it just fluently, like it's not going to have to be paid back. I know that credit cards are easier to spend versus debit cards, because once the debit card diminishes to zero, then there's no money in your bank. Credit cards are different. So try to create habits on your credit cards like a debit card. Spend only what you need. That's the best advice that we can give, and that'll continue to boost your score also with the credit score on your FICO.
I'm gonna show this video to my wife, by the way.
Hey, let's share it to each other's wives.
I know.
Yeah,
Okay.
absolutely. That's a I guess you could say a consejo or advice that you can give to anybody, but that's probably one of the hardest ones that most people just don't want to follow. I know that times are tough. Sometimes there's only like one income source in the household, so sometimes credit cards are needed to go for like the day-to-day expenses or the month-to-month expenses and then pay it back. But if you can, try to not or limit yourself with credit cards and just continue paying down the current balance instead of adding more balance to pay down, to add, to pay down, etc. That's going to be a big impact on your credit score.
Yeah.
Um,
So that the higher the FICO score, the better rate you're gonna get. Correct?
that's correct. Yes,
Okay.
that's correct. And for some clients, don't think that you need a 700 score in order to even qualify for first-time buyer programs. We have programs down to 550 for government financing. The interest rates are a little bit inflated, but of course, you can at least buy into a house versus not buy a home. So you don't need the most perfect credit to buy, but the best advice is try to improve your credit as much as you can in order to be in a good position. And even if you're not, the millennial team and we're here to create a game plan for you. Even if you're not ready to buy today, next month, 3 months, or 6 months, even if it's a year, we've helped clients buy several years later. And if you're coachable, you're absolute. We promise that we're going to fulfill your American dream of home ownership. That we can promise.
That's true. Well, thank you, Jeremiah, for being here today.
Thank you.
If you guys are considering buying a home, feel free to reach out to us so we can help you. Like Jeremiah mentioned, it's a free consultation. We don't charge anything for that. But the goal is mainly to create a plan. A lot of families that come to us, they're not ready right away. But the goal is to create a plan based on where you're at that moment. So that way, hopefully, either by the end of the year or next year, you're able to purchase a house.
Yes. Yes. Thank
Well,
you for
thank
the
you.
invitation,
And we
Edwin.
have a small guest. Let me see if we can. Hey, Charlie. So, yeah.
What's up, Charlie?
Charlie's visiting the office today.
That's awesome. That's awesome. Yeah, folks. Edwin and the team, thank you for the invitation for today. I'm always happy to do these little Zoom calls with our audience. And of course, like Edwin said, just reach out to us. Everything is free. You have nothing to lose. You only have everything to gain. Our knowledge, our experience, and our education and our game plan for you.
That's
So
true.
please, no obligations, but we're here for you guys. Thank you.
Thank you, Jay. Have a